Okay, we want to talk about chapters 11 and 12. Chapter 11 deals with public goods, common resources, etc. There's not a lot of content or economic theory in that chapter, so what we're going to do is today we're going to review chapters 11 and 12. I'll go through both of those, and I'll send those out to you. Your quiz, therefore, will on Tuesday be, on Thursday, will be on chapters 11 and 12. Okay, so let's get going. So chapter 11 deals with public goods and common resources. Actually, public goods and private goods as well. So let's take a look at it. Bottom line, there's no such thing as a free lunch. Everything has to be paid for in one way. Um, the problem with a lot of people's thinking today is that the government owes them something. The government doesn't owe anybody anything. They're attempting to, as we saw in the last chapter, to do everything they can to make sure resources are distributed as equally as possible. In the market system, the income determines how much you can buy. But there are certain things that have been put into place to help people who are less fortunate for one reason or another and who need assistance. And those things include such things as Social Security, unemployment insurance, food stamps, etc. So the bottom line, however, though, is even with those things, sooner or later, all those things have to be paid for. Somebody has to pay for the food stamps. Food stamps, for instance, are free if you qualify, and you don't pay for them, and you receive them. And there's no competition for it. If you qualify for food stamps, you're not competing with the guy next door or the person next to you for food stamps. If you qualify, you get the food stamps. And the bottom line is, of course, that if you're a participant in the food stamp program, you probably don't make enough money to pay taxes. So as a result, therefore, you're not paying for them, for what you receive. Okay, because one person gets food stamps does not mean that another can't get them because they have been consumed by someone else. The reason this is stated that way is it harkens back to the whole market system. If you look at the market system, we are really in competition with one another for goods and services. We may go to the grocery store and there's plenty of things on the shelf, but we're competing with all the other people that want those things on the shelf. And we buy them to consume them. And once we buy it, that particular item, no matter what it may be, is not available to anyone else. It's strictly ours, and no one else can buy it. It's been purchased, and it's been purchased for consumption. So, thinking backwards to food stamps, there is no rivalry for food stamps. In other words, if you get food stamps and you qualify, you're not competing with another person who's qualified for food stamps. They're a government good. They're given to you, goods and services by the government, and you don't have to compete for them. You don't have to bid for them, if you will. You don't have to raise a price for them, if you will. If you're qualified, you get food stamps. So let's look at what's a good versus a private good versus a public good. Now, obviously, private goods are goods and services that are traded, bought, and sold in the free market system. And public goods are those goods issued or given out by the federal government or state and local governments. So private goods, those are my chocolate chip cookies. They have a rivalry. If I go in and go to purchase them and someone's standing in line before me or at that shelf or that counter and they grab it before I do, we have engaged in a competition, a rivalry for that particular good. And whoever gets it, and it's a private good. You get it for consumption to consume it. And if it's me you took it away from, I'm no longer there to buy it. I may have the money, but you've got it and it's yours. So one of the key elements of a private good is the fact that there is a rivalry involved. The second element of a private good is there's excludability. Once I've paid for it, you're excluded from it. I'm going to buy it and I'm going to consume it. Chocolate chip cookies, I'm going to eat them. And you won't have the opportunity to do the same because I've purchased that box of chocolate chip cookies. So you pay for it with your income and you consume it. It's excludable, it's only yours, and that's the only thing you have to worry about is the fact that you can now have it to consume it. As opposed to public goods, again, the food stamp issue. There is no rivalry. I'm not competing with another person who may also be qualified for food stamps. We're not negotiating a price. There is no give and take in terms of who can put up the most amount of money to get the food stamps. So they're consumed by one person, and that does not exclude anybody else from not getting the same good. Now we're talking about the stamps themselves. Of course, they're used to purchase food for the family, but what we're talking about is actually receiving the food stamps themselves. So there's no rivalry for food stamps. Secondly, there's no excludability. So unlike private goods, there's no excludability and there is no rivalry. So just because I got food stamps, it doesn't mean you are prevented from getting food stamps because I got them as well. So the key to understanding the difference between public and private goods, it has rivalry and excludability. In other words, I'm competing with you for it or someone else. And if I get it, I'm excluding it from your purchase. Public goods, on the other hand, there's no rivalry and there's no excludability. Okay. Other non-rivalry types of goods. Common resources. There's no rivalry for fish in the ocean. As long as you go out in a boat, have a permit to fish, if it requires a license, you can fish the ocean for all the fish that the license permits. Okay, so that's a common resource available to everyone. Anyone can go out in a boat and go fishing as long as they have a boat permit, and a license to fish. Secondly, a common resource is the environment. Not paid for, but we may require a license to pollute. But we don't require a license to breathe the air. We don't require a license to pick a flower necessarily. We don't, to enjoy the environment, we're not required to have a license, unless of course we're talking about polluting. Now, the other part of that, however, though, is if you want to go to a park, that park may charge a fee for you to have access to the park. That's different. Then he talks about club goods, and there's a chart in your book that's excellent. We'll go through it before you take your quiz. Club goods are things like cable TV. It's not essential, but it's available as long as you want to pay for it. Some communities actually contract with a cable TV company. For instance, I live up in Lantana, and the community contracted with Verizon initially. It's now Frontier, to provide all the cable TV and services that cable system goes with. In other words, we have in our house, we have the TVs, we have the DVRs on each of the TVs. We have the telephone, which is also driven off the internet. We have the internet connection, and so on and so forth. So they contracted with the cable TV company, Verizon, now Frontier, to provide us with these services. Another club good is fire protection. I think we pay about $170 once a year for fire protection. Fire protection, meaning that if there is a fire, we call the fire department and they will come and put the fire out. In most cases, it's paid for by local taxation. In our case, we send a separate check for fire prevention or fire protection. But it's it's a paid for service, but it's a club good where everyone can partake in it. Cable TV, fire protection. Okay, any questions? Just a difference between those two. When we're talking about common resources, we mean we can access anybody's. We're talking about club goods. We're talking about particular services that we have access to through our local community or whatever. All right, public goods further. They're quasi-public goods that we talk about, which are called streetlights, license requirements, the double yellow line in the road, the stoplights. Green means go, red means stop, and the amber light means hit the gas as hard as you can so you get through the intersection before it turns red. So these are public goods and quasi-public goods that are provided by the government to us as part of our taxes that we pay to the local government. Now, whether we pay taxes or not, for instance, we can take advantage of the fact that we have streetlights, take advantage of the fact that we have a license requirement for driving, etc. Okay, users of public goods may or may not be the source of income to pay for that good. Food stamps, again, is another example. If you drive through a town and that town pays the money to put up traffic lights, to put double yellow lines down the roads, and you're not a member of that town, but you enjoy the benefit, so you are a user of that public good without being required to pay for it, because the government dictates that towns, cities, etc., should have traffic laws that everybody who enters that town has to abide by those laws. Even though we haven't paid for them, they're available to us. Regulations and government edicts that are put out, mandates, are developed basically to influence how we use the goods and services that they provide. Again, for instance, speed limits. We are required to maintain or stay within the limited speed, or 5 miles over the posted speed limit. But those are regulations developed to influence the use of demand for goods and services, or the use of our public goods or quasi-public goods that are out there for us to utilize and to abide by the rules. So, how efficient is the government determining which goods and services to provide? It all depends. In some cases, they've been very successful. In other cases, there are unintended consequences. Probably the classic example is under the previous Bush administration, a law was passed that said the U.S. would allow women in danger, particularly in Latin America, in danger for physical harm, and their children from physical harm, could come to the United States, not under the immigration rules, but under what they call the ability to be you're under duress and you're granted asylum in this country. You don't have to go through the process of entering the country or going through quota. You're granted asylum. So that particular law was a good intended law to help people in less unfortunate situations that were in fear of danger to their lives. The problem is, in many cases, it was abused and taken advantage of. I think in one case, in 1 month, we had probably 60,000 people come up from, I forget what country in South America, and enter the United States under the terms of that law. So it was a great idea, but there were unintended consequences that we didn't foresee when that law was put into effect. Free riding. We talked about this before. Free riding is you get the benefit of the event or the product without having to pay for it. I use the example of Gaylord Texan and Grapevine, Texas. They put on fireworks during the summer every single Friday night. You don't have to go to the Gaylord to see those fireworks. You can sit on the shore of Grapevine Lake and you can witness them without paying a dime. Why does the Gaylord do it? They do it to promote their hotel, and hopefully you'll come there to have a drink, a dinner, or come see the fireworks. All right, the management reasons that it will bring people into the hotel, as I just said. It's a publicity stunt. It's branding. It's all the things that businesses need to get people to come and stay in their hotel. All right. This is a lot like, again, town of Louisville puts on 4th of July for the residents of the town. But you don't have to be in the town to see it. The land around Louisville is fairly flat. You can be pretty much any place in the immediate area within a few miles, and you will be able to see the fireworks. So why do they do it? Well, they do it because they're promoting their town and their city. And as a result, they assume and hope that people will come into town to watch the fireworks. And therefore, the merchants in town will sell more goods and services to people. So again, it's a promotional thing, just like the Gaylord Texan. All right, cost-benefit analysis. This is the difficult part. Typical analysis done to make a business decision acceptable. Now, in business, when you want to spend money, you've got to do an analysis and forecast what's going to help happen as the result of your expenditure or your promoting that business decision. When I first went to work for Burroughs Corporation, I was on the corporate staff as a forward economic planner. And what we had to do was work on the justification of new manufacturing facilities around the United States. Burroughs is in the mold of expanding, and they needed to expand quickly, and they needed to expand not in the area of adding machines, which was their forte, but in the computer business. So what we had to do was do analysis of where to put different plants that were acceptable, that were a good location. I know I did the justification for one in Mission Viejo, California. I subsequently later became the controller of that facility, but we put them in mostly in mild climates. Hollywood, Florida. We did have one in Pennsylvania. We probably had 3 in California. As far as north as Pasadena above LA, and as far as south as San Diego County. So anyway, what has to be done in business is they have to do an analysis of what they're going to spend, how much money they're going to make back as a result of that expenditure before they make the decision. So we employ in business what they call a discounted cash flow. Discounted cash flow means all it is an inversion of the benefits that you see when you take out a savings account and you have the ability to improve or earn interest on interest. Okay, this is the reverse of that. It's a discounted cash flow. And what it says in the business environment is, if I didn't spend this money on this new factory and I left it in the bank earning interest, where would I be better off? Am I going to make more money putting it in the bank, or am I going to make more money investing in a new production facility? So they use, in doing that, the reciprocal of compounding interest, as I said, and what they do is that determines the yield. And what that does is it recomputes the factor for interest gains as a result of investments and a yield on your return on investment. So what it is at the reciprocal, it allows the business to look at their expenditure in terms of alternative uses for the money, in this case, interest. Now, this is really difficult to do in terms of welfare economics because the return may not be measurable economically. For instance, how do we measure, in the case of food stamps again, how do we measure what the real yield is on that investment by the government? So they have a difficult time doing a cost-benefit analysis. Now, when the government goes into a program, particularly in the area of Environmental Protection Agency, and they put out regulations, they are supposed to do a cost-benefit analysis of a regulation. For instance, limiting the amount of herbicides, okay, or other elements like that that the EPA gets involved in. What they're supposed to do is measure the benefit or the lack of benefit that occurs as a result of putting out that mandate. So if I mandate something to the population, let's say in farming and agriculture, and it has a negative impact on agriculture, I've got to say, all right, that negative impact is more than offset by the positive impact of my mandate. Very difficult to do. They're supposed to do it. They don't usually do it. Okay. Again, this is another example. Intersection yields traffic accidents. So what people do, or what the government will do, is put a traffic light in where accidents occur, and hopefully that will reduce the number of accidents. Now, how does that benefit the community? Well, there are fewer police calls as a result. Fewer police are dispatched. EMT units and fire units are not dispatched as frequently. So there is somewhat of a cost benefit to spending the money to put a light in versus leaving it the way it is and continuing to have to deal with accidents at an intersection. Difficult to measure, though. Difficult to do a cost benefit analysis. All right, so let's go on to Chapter 12. Chapter 12 deals with the tax system, and we're going to talk about the tax system in the U.S. Excuse me, and who pays for what. Just a general point of view, we have a tax rate system, a marginal tax rate system, which is also called a progressive tax rate system. So the more you make, the more you pay in taxes on income. Okay, Benjamin Franklin, word of wise to everyone, nothing is certain in this life but death and taxes. So you're going to have to pay taxes, no matter what you do. Okay, the federal government, as I said, operates what's called a marginal income tax system, which means the more you make, the more you pay. So the higher your income level, the higher the tax rate that you're going to be subject to. We'll talk about how you calculate that in a minute. Now, most state and local governments on income tax, they have a fixed tax rate on income. Whereas our tax rate on income in the US is marginal or progressive, the states usually charge a flat tax. We're lucky in Texas, there is no flat tax. However, the stuff we have to pay for, we have, let's see, a very high property tax rate in Texas. No income tax, but a high property tax rate. Other states have fairly low, like California, fairly low property tax rates, but a high income tax rate. So it all depends on how the state or the local community operates. All right, so how do we fund the private sector? In the US, we have a marginal tax rate system, and we tax individuals and corporations. Now, we also deal with something called the average tax rate. And this is a little different than the marginal tax rate. For instance, you make $100,000, you're probably in the 25% tax bracket. So if someone would look at that and say, if I make $100,000, I've got to pay $25,000 in taxes. Well, not exactly, because from that gross income that you have, the Internal Revenue Service allows you to deduct certain things. There's a deduction for dependents. There's a deduction for mortgage interest. There's a deduction for charitable contributions, etc. So what we mean when we say the marginal tax rate, that's the stated rate, 25%, but the average tax rate is actually what you pay. For instance, $100,000, you may only have a real or average tax rate of 20%, not 25%. And if you want, when we get in class, I'll go through how that works. And lastly, the federal government also levies excise taxes, gasoline, cigarettes. We talked about that today. They levy taxes, excise taxes, they call it sin taxes as well. Cigarettes, alcohol, gasoline. The object behind it is, again, as we talked about with externalities, the idea behind the gasoline tax is to reduce the use of cars, pollution, congestion, accidents, etc. Behind cigarettes, the same thing, pollution or secondary smoke, environmental problems, and also the health problems created from secondary smoke from cigarettes, and alcohol because of the abuse of alcohol. So these taxes are put in there to try to keep these things out of the hands of people who would abuse them and create additional problems. For instance, a large part of what we pay out in Medicare for older people are the result of people smoking most of their lives or consuming too much alcohol. It's an attempt by the government to control that and reduce the negative externality. All right, state and local governments generally, as I said, rely on a flat tax rate for income, what they call a lump sum tax or a flat tax rate. Generally, what most states do is they will pretty much, their state income tax return follows the federal income tax return. And generally what you can do is just relate one to the other. Excuse me. And then transfer numbers from the federal tax rate system, form to the state tax rate. All right, they also levy sales taxes, which we talked about earlier, the deadweight tax. You go to the grocery store, you buy something off the shelf, it's marked as $3.50, take it through the cashier, the $3.50 becomes $3.75 because the government has put a tax on that. And that is forcing the price higher than the equilibrium price, and therefore it's called a deadweight tax. Okay. Now, most of those receipts, particularly property taxes, and at least in Texas for sure, and California that I know of, they're used for education purposes, building schools and educating the population. Now, states and local governments also have excise taxes, sometimes, as we said before, sin taxes. But states also tax gasoline, cigarettes, and alcohol. They've got to get their share. Okay, the average tax rate. Marginal tax rate is the published rate the IRS and in persons use on gross income. That's the example of the 25% I mentioned. But as we said, taxpayers are allowed to deduct from their gross income, that would be the $100,000 that was reported to me by my company on a W-2. I can deduct mortgage interest, state and local income taxes, medical expenses in excess of 7% of my gross income. That means, for instance, that if I'm making $100,000, my gross income is $100,000. That means I can only deduct medical expenses over $7,000 in a particular year. We can also deduct property taxes and on our personal residence, and certain education expenses are deductible. So those are the things that make the difference between the published tax rate or the marginal tax rate or the progressive tax rate and the actual average tax rate that you actually pay. Federal tax brackets. These tax brackets are 2016 tax brackets. They've issued new ones for 2017, but they may change as well if they get this tax proposal through Congress before the end of the year. We'll see what happens. But anyway, here's the 2016 rates. So we classify them in two categories: single or married, filing a joint return, husband and wife filed together, and what the tax rate is for those people. If you make up to $18,000, your tax rate is 10%. 37 if you're single, 37,000, or 75,000 if you're married filing jointly, your tax rate is 15%. Up to 153,000 filing jointly, you get to 25%. 233,000 is 28%. 416,000 is 33%. 470,000 is 35%, and the maximum rate is 39.6%. And you have to make in income over $470,000 for that year. So that is the highest possible tax rate. That means that roughly 40% of what you make is going to be paid out in federal taxes. And you can see the concept behind this of the marginal tax rate increasing from 10% to 39.6% based on the amount of income that you make. Well, that's why we call it a progressive tax system. The progressive tax system says the more you make, the more you pay. Tax rates. Again, it's a progressive system. The more they make, the more you pay. Now, there are different levels to it and there are other categories. And one of the major ones that people are concerned about today is capital gains tax. If, for instance, and this applies to purchase of stocks, if, for instance, you buy a stock on January 1st and you pay $100 for it, on December 31st, it's worth $150, and you decide you're going to take the $50 profit. Well, that profit of $50 is now taxable at ordinary income tax rates, which means that you will fall into, let's say, the 25% tax bracket. Now, that is short term. Short term means less than 1 year, so 12 months or less. If you go to 13 months, the rate changes. It becomes a long-term capital gain as opposed to a short-term capital gain. So if your tax rate is 0, but you still have capital gains, you may pay 15% tax bracket. If your tax rate for capital gains is 15%, that means you're in the 25 to 35% tax bracket. And if your tax bracket is 39.6%, you're going to pay 20% on any gain you make on the sale of a stock. So let's say we have a bunch of stock, we paid $10,000 for it. In 13 or 14 months, we sell it for $20,000. We've made a profit of $100,000. I mean, $10,000. What that means is we owe capital gains tax on that of $2,000. So that's how it works. Now, I have a chart that I'll show you, remind me in class to show you the CNN chart. It's kind of interesting because it shows all the income, property, and excise taxes by state. The one I have is 2010. I think they do it yearly. You can look it up if you need to get more current information. But it's interesting. It says the highest tax state is New York. Texas is down around 45, 46 of the 50 states. So we are a very low tax rate. Now, we should be even lower than that if we didn't have high property taxes. So I'll show you that chart. We'll bring it up on the screen and you can take a look at it. It's kind of interesting, particularly for you guys. You're going to be getting out of college and get a job. You may be asked to work outside your current state of Texas. Now, the tax situation in the state in which you go to may be totally different than Texas, and you need to take that into consideration based on the income that the company is proposing to pay you in another state. Okay, in addition to that, one of the unfortunate things that happened during the Great Recession was the implementation of the Affordable Care Act, ACA, often known as Obamacare. And what it says is that if you make over $200,000 on any investment income, of any amount above $200,000, you have to pay a surtax of 3.8%. And that goes on top of any regular income taxes you may have to pay in that particular time frame. So if you made $200,000 on any investment or investment income, you've got to pay an additional almost 4%. And that money is being used to take care of the cost of the Affordable Care Act. Unfortunately, it's not enough, but it was an attempt to take care of it. Now, how it is investment income? Here's the way they defined it under the Affordable Care Act. It's defined as interest, dividends, capital gains, rental and royalty income, and passive investments like limited partnerships. A passive investment means you don't take you're not an active participant in the investment. This is typical of what they called limited partnerships, where one person or a company, a general partner, would go and buy, for instance, an apartment building. And then he would then take in investors, and each investor would contribute X amount of money, portion of the investment, and that investor would get, number one, the depreciation associated with that investment on their income tax, and also any profits or any gain that came from the future sale of that particular investment, limited partnerships. They're called limited because they have no liability. The only one who has liability is the general partner. So he's liable for everything. He gets served, he gets processed, and limited partners are totally free of any risk in terms of illegal activities, etc. Now, that's what they mean by passive investment. The limited partner does not make any decisions, nor do have any input into the management of the investment. Okay, again, this was part of the ACA Act, and in 2013, it was implemented in 2013, sorry, and it's expected to bring in $30 billion this year. And I think the cost of ACA is a heck of a lot more than that. Okay, who pays what? This is a chart on different income levels and how much money they have to pay in taxes each year. The footnote at the top, France adopted the idea, let's tax the rich. So they put a 75% tax on anybody with a higher income. I forget what the threshold was for that income, but at any rate, they did that, and then I think it lasted maybe 2 years. They took it off last year. The problem they had was the high income people left France, did not take up citizenship. France went to other countries, and the tax of 75% tax had zero impact. So they dropped the whole thing. It's one of the things you got to be careful of in taxing. Okay, so here's a chart of who pays what. This is the taxes paid by income groups for the year 2010. Now, this is the amount of money going to the federal government by all households. So the first group is the 1st to 20th percentile. Average income of 24,000. You'll see up in the right-hand side, and they pay 0.4% of the taxes going to the federal government. The next percentile, the 21st to the 40th, these people are the $44,000 people per year income. They pay 3.8%. The next group is 41 to 60, and the average income there is $65,000, and that represents about 9% of the total money going to the federal government in the year 2010. Now you look at the 61st to the 80th, you understand what I mean by a percentile, the number of people in that grouping as a percentage. So 61 to 80%, $95,000, and they pay 17.6% of the taxes going to the federal government. The biggest category is in the 81st to 99th percentile. The average income range is somewhere between around $35,000 and $286,000 a year. 44% of the people, of the money going to the federal government, comes from this category. Now, the interesting thing is that if you added that grouping with the 61st to 80th grouping, 17.6 and 44.6, you would get what, 60%, okay? So 60% of the money going to the federal government is coming from what we classify as the middle class. Now that's important because we keep talking about creating jobs for the middle class. And this is why we want to create jobs for the middle class, because they pay a lot in taxes. By the way, this information comes from the Congressional Budget Office. So then let's look at the top group. Top 1%, average income $1.4 million a year. They pay 24.2% of the money going to the federal government. Now, judge for yourself, form your own opinion, but because of our progressive tax system, they are paying a lot of money into the government. If you look at the situation, what France did, 75% on higher incomes, there aren't that many people in that category, and you can raise that tax rate, but guess what? You're not going to get a lot of dollars for it, okay? Because there aren't a lot of people in that category. And as in the case of France, they may get fed up with the whole situation and leave, take up residence in another country with a lower tax rate. So anyway, take a look at that. Let me know what you think about it. It's kind of interesting chart. All right, maximum tax rates by selected countries. I think I've showed you this already, but let's look at it again. The problem we're facing is that we have a very, very high tax rate, 35% in the US down on the bottom for corporate. Now let's talk about corporate. We got the countries listed on the one side in alphabetical order, the major countries, samples. The corporate rate for those countries, look at Canada, 11 and 15% compared to our 35 and 13. The 35 is the federal rate, the 13 is what the state and local averages out to be. So you compare that to Singapore, 17%, Hong Kong, 16.5%, Germany, less than 30%, France, 33%, China, 25%. Closest one is Japan at 37%, and I believe they've dropped that rate since then. Now, here's the situation and here is the problem. We have the highest tax rate corporate-wide of any country, industrialized country in the world. And as a result of that, our companies who do business overseas don't bring any money back into this country. Let's suppose, for instance, that they make $1 billion in Singapore. They're going to leave it in Singapore because they're going to pay in Singapore 17%. If they brought that money back to the United States, they would have to pay the difference between 17% and 35%, plus the 13% state and local. So money made by U.S. corporations in foreign countries tends to stay there. Think about how neat it would be if we can get that money back here and grow this country and build new factories and buy more equipment and increase technology. It would be awesome. The current conversations that are going in Washington, still too soon to judge or say this is what it's going to be. They're talking about a corporate tax rate of 20%. If you look at the personal rates by country, we're not too far off the other countries of the world. Personal tax personal tax rates, for instance, aren't too far off. You know, you think about NAFTA, and we always talk about labor rates in Mexico in particular. But there are other issues that affect price. And one of them is how much taxes a company has to pay. If you compare the tax rates for Canada and Mexico to the US, they have a decided advantage in how they can price goods and services into the US that we don't have because of our higher tax rate. All right, future spending. I showed you this chart earlier in the course. If we don't get a hold on control of our debt, we're currently at about 20 trillion. If we don't get control of it, we will need to borrow and issue more and more bonds, which is a loan to the government, to just pay the interest. And that interest amount is the red part of each column. And it becomes bigger and bigger as time goes on, and we have to continue to borrow and borrow more. Now, what's wrong with that? As we've talked about before, what's wrong with that is that we will have to use our money to pay down our debt, and we will not be able to use it to invest in companies. We will not be able to invest in new technology. And that would cause stagnation within the economy. And we don't want that. All right, federal budget. A balanced budget occurs when tax revenue received by the government is equal to what they spend in the year. Now, balanced budgets, we've talked for a long time about putting in a balanced budget amendment to the U.S. Constitution. Never done it. But we tend to spend more than we take in by a lot. I think the budget this year is going to go over, I think they said something like $668 billion in the red. The budget being what the federal government says I'm going to spend for the year and what they actually spent. They budgeted a number and they spent $668 billion more than what they budgeted. It's kind of a joke. So if we talk about a balanced budget, we mean receipts are equal to tax receipts are equal to expenditures. I got a typo error in there somewhere. Yeah, fiscal year is qual to the amount they spend in that year. Okay. I'll fix that. Budget surplus. This happens when the tax receipts exceed the current expenditures. The last time we saw anything like this was during the Clinton administration. For several years, we had a balanced budget where the tax receipts exceeded the actual expenditures for the year. That's the last time. And a budget deficit is when the tax receipts are less than the expenditures in a fiscal year. We don't want deficits, but that's what we've been living with. Now, what does the government do? When they spend more money than they take in, they have to borrow money. How do they borrow money? They issue bonds. And we as citizens in foreign countries buy them, foreign residents buy them, and we buy our bonds. But make no mistake, a bond sounds like an investment, but it actually is a loan to the federal government. Chronic budget deficits. We are not good at managing our spending. Things tend to get in the way. We tend to look at, we've talked about externalities. We tend to look at trying to solve our problem of externalities by throwing money at it. And as a result, we've spent ourselves into a big problem, almost $20 trillion. Now, when we talk about the budget deficit, the budget is an amount of money that we say we're going to spend in a given year from September to September. And if we have a deficit, that means it's how much we've missed our target by. In this case, it's almost $668 billion. So how do we fix the problem? Well, the best way that the federal government has to fix the problem is to raise taxes or reduce spending or both. They've been reluctant to do either one. But sooner or later, we're going to have to face the problem and get this thing back under control. We have to do it. Budget deficits. It's easy to do because all we have to do is print more money. If you look at the states can't print money because they have a balanced budget amendment in their constitutions, with the exception of Maine. And at the same time, they can't print money. The federal government is the only one that prints money. So the debt crisis and debt level rise is too high. It'll be very difficult to pay the money back. And in paying it back, we'll have to take money away from the private sector for investments in technology, etc. People recognize this. Standard & Poor's recognized it, and they downgraded the U.S. Credit rating from AAA to AA+. Greece today is an example of what can happen when you spend more than you take in. All right, deficit spending and the public debt. Federal government deficit exists when we spend more than we take in tax revenue. Balanced budget exists when tax receipts equal expenditures. Government surplus exists when tax revenue exceeds those expenditures, again, as we said in the Clinton administration. And public debt is the result of government having to borrow money from the public by issuing bonds, and a bond, in effect, is a loan to the government. We pretty much covered this before. This is just kind of a recap. U.S. national debt. As of 2015, the national debt, 2015, I had the data on, so we'll talk about 2015. So as of March 2015, the public debt stood at $13.8 trillion, or about 74% of the Q4, quarter 4, 2014 GDP. Now, what does that mean? What's the public debt? We have on top of that the intergovernmental debt. This is holdings that stand that we owe of $5.07 trillion. The main part of this is Social Security and Medicare. The combined total of this debt in 2015 was $18.15 trillion, or 103% of Q4 GDP. Now it's approaching $20 million, We haven't got the statistics yet for the full year. Of course, we haven't finished the year, but my guess is we're going to be a lot higher than 103% of our GDP. And that's not good. That means we're spending way more than we're making. Now, 6.1 trillion of that 20 trillion roughly is, or 47% of public debt is owned by foreigners. We often talk about China. What would happen if the Chinese decided they wanted all their money back in cash, all their bonds, all their money that they lent us? They have probably $1.5 trillion worth of US dollars in one form or another. What would happen if they demanded all that money to come back? Well, there's 6.1 trillion out there in different countries. Japan and China probably account for about half of that 6.1 trillion. In the case of China, it wouldn't behoove them to require us to pay back that debt anytime they want it, because we're their biggest customer, and that would jeopardize their ability to get money from us and buy their product, and it would have a negative impact on their economy. Now, let's be realistic. China's doing a good job of going around the world and finding new customers. So continuing on national debt. Of the 6.1 trillion, as I said, about 3 trillion, half of it is owned by China and Japan. Now, that national debt number that we use, approaching 20 million this year, does not include anything owed by state and local governments. State and local governments issue what they call municipal bonds, and those bonds are issued to build roads, build schools, etc. But none of that is included in this calculation. So how come we have this debt? Well, we spend more than we take in, obviously. And we're operating at a deficit in all federal government operations. In my opinion, we could probably reduce government expenditures by 10 to 15% and not lay off a lot of people from the federal government. Remember, the federal government employs about 40% of the labor force, the federal, state, and local governments. So 40% of labor force works for the government. Now, the current national debt. This is public federal debt. It's approaching, as you can see, $20 trillion. And you can see what's happened to it. And this one points out when Barack Obama took office, we grew exponentially in terms of the debt. The Affordable Care Act was a big part of this. The continued payments for unemployment, the requirement for additional food stamps, more and more people are on food stamps. We continue to spend too much money. Paul Krugman is an economist. I believe he's at Columbia University. I'm not sure. It's the last I knew where he might be. But anyway, he's kind of a liberal economist. His comments are interesting. Now, what he says is it's true foreigners hold large claims, Japan, China. However, we have large claims on other countries and other foreigners. So for every dollar that we owe, we have 89 cents worth of claims on foreigners. So almost 90% of our debt is covered. The problem is going to be, how do we get that money back if we need to claim it? And will we get what we've put up? So Krugman says America actually earns more from its assets abroad than it pays to foreign investors. Well, you know, that kind of makes sense because the economies abroad are not as strong as ours. Their interest rates are higher so that they can attract foreign investors. You guys can think about this. All right, now there's a problem. It's called unfunded obligations. The national debt does not include unfunded liabilities that represent future claims on the government that haven't come due. For instance, retirement benefits for that 40% of the labor force that works for a government, health insurance for those people, dental, medical, dental, optical. These are all liabilities that these entities have. Federal government, state, local, city of Dallas has a problem, Fort Worth has a problem, Houston has a problem, Austin has a problem. They all have unfunded liabilities. The GAO, Government Accounting Office, estimated that would be about $45.8 trillion. 7.7 trillion of it is future Social Security benefits. 38.2 trillion relates to Medicare and Medicaid. The bottom line, the national debt, including unprovided for benefits, totals to $62.0 trillion. That does not include any state or local governments, that's federal only. So we have a huge problem down the road. The Congress has refused to take responsibility for it. They continue to kick the can down the road. As yet, no one has really started to address this problem. Intra-government debt, what's that all about? These are non-marketable securities. Intra-government debt is part of the national debt, but it's money that's owed to us through Social Security and Medicare. And this is Social Security Treasury bonds. They're part of the debt, and they're held to fund future Social Security benefits. We talked about that when I gave you that presentation on how Social Security works and where the money comes from and where it's going. So another part of the intergovernment debt is Medicare. So Medicare and Social Security account for most of it. The Social Security system is in pretty good shape relative when you compare it to Medicare. Social Security started a lot earlier than Medicare, and we're contributing a lot more to it than we are to the Medicare system. Okay, origin of the Social Security debt. We did that some time ago. Let me go back to that a minute. I gave you a presentation on Social Security and how the debt arose. And I think you probably understand that what was done was they created these treasury bonds and they used the cash to fund current expenditures. CBO took a look at some of the problems. They said, you know what, you got to do something about it, because if you don't, the money that we have, the savings, we're going to have to use it to purchase back government debt rather than invest in capital goods and businesses and technology. We also increase the risk of financial crisis, because what will happen if we have to do that and we have to use all our money to pay down that debt, we are going to demand a higher rate of interest to do that. And by demanding a higher rate of interest, we increase the debt load. Okay, as I just said, rising interest rates will cause a reduction in government programs. The stuff they should be doing now will be forced to do, and it will restrict the government's ability to follow fiscal policy needs, which is coming. Higher interest rate means higher taxes to pay for that interest. So the bottom line here is that if we don't get this under control, two things could possibly and probably will have to happen. One, you're going to get a higher tax rate for your income taxes to pay for this off. And two, you're not going to have the money to invest in other things like technology, growth of business, capital expenditures, etc. So it's going to end up being kind of a waste. So the Government Accounting Office said, you know what, let's take a look at what you're spending your money on and let's see where we could cut. And by the way, none of this was ever acted on. They looked at it and they said, you know what, we have 100 programs that are related to highway and rail transportation. Now, there's only 50 states. That means there's 2 programs per state. So the question the GAO office recommends or says, why do we need 100 programs? Now, you have to understand what a program is. That means that there's a committee chairman, committee members that can hire consultants that are spending a lot of money to take a look at highway and rail transportation. 100 different programs. We really probably only need two, one for highway and one for rail. Maybe there's an alternative too. But 100 doesn't make sense. All these programs have their own staffs, their own budgets, their own costs that are in excess. We don't need 100 programs, according to the GAO. I think they're right. There are 82 programs to improve teacher quality. How's that working for you? Who knows what that's for? How's the money being spent? Where is it? Okay. Where do we see it coming in and helping? Again, 82 programs, lots of people in those programs, committees, consultants, etc. 80 programs to help low-cost people with transportation costs. Okay, that makes sense. Help low-income people with transportation costs. But do we need 80 programs to do it? Again, there are only 50 states. 80 programs to promote economic development. Same thing here. There are only 50 states. How many programs to promote economic development do we need? Again, there's a whole bunch of overhead, people and dollars that go with all these programs. And then 57 programs to help U.S. residents become more financially literate. Boy, I wish they'd do that right. Okay? We could all use a lot of help understanding finance. It's probably the weakest link in some of the things that we do. So this is General Accounting Office. This is their estimates of where things can be cut and where we've got too much money being spent. So it's possible. We can get this thing under control. We just have to find somebody who's willing to take the initiative. All right, A.J. Aaron, a fellow for the economics fellow at the Brookings Institute, did some analysis on government spending as well. In Medicare, he found $60 billion was paid out for services for no valid purpose and or phantom services that were never provided. Now, the way this happens is you go to the doctor and he looks at you, says, yeah, you got a sore throat, or does your physical, and he bills Medicare. And he bills Medicare more than the service he provided for. So you pay a copay and he ends up billing Medicare. This is pervasive. So $60 billion was paid out for services that were not valid and or they were phantom services. You walk in there, how you doing, doc? Great. He sends a bill to Medicare. Taxes. There are $540 billion in taxes owed but never collected. Now, if you compare that to last year's budget deficit of $468 billion, it would be more than enough to balance the budget. Okay? So just collect the money people owe. Disability insurance, this is a big one. $161 billion in payments that was supposed to stop when the insured person went back to work. But that rarely happens. What does happen is you get better, you go back to work, find another job, and you continue to collect your disability insurance payments. It's called double dipping. Interest payments on debt. I think I showed you this chart before, but here you have different levels, different years. And you'll see in 2012, 2011, that the national debt, the deficit was $432 billion of interest expense, which means that of the federal budget, let's say that we go $668 billion this year. That means that almost 80% of it is interest on the debt. So we're getting into crisis situation and we've got to step up to the plate and do something about it. All right, that's it for now. Take a look at that. If you have any questions, bring them to class on Thursday. And we'll go through anything you need to cover. We'll go through what's in the book on chapters 11 and 12 and answer any questions you might have. So in the meantime, enjoy your weekend, and I'll see you next Thursday. Bye.